Um, Hi, this is Manoj Abhichandani, and thank you for registering for this webinar. Um, and I'm thinking that uh, this is your first time you are attending a webinar, and just some housekeeping issues. You'll see on your dashboard that there is a pop-up window, and there may be webinar number with a phone number. So if you can't hear me properly, I'm using a very high sophisticated high-end microphone. I cannot do anything better than what I'm doing at this end. So you might have to dial that phone number and enter that webinar number to hear me more clearly. Now, I'm going to also request you to hold on to your questions. There is a box for questions, and if you can put in your questions there, and after the end of the seminar I will be trying to answer most of those questions. Now just to repeat, if new people have joined, if the sound is not okay, then that phone number is your only option and there's no other option, and I cannot help you anything further. Now, today we're going to talk about pensions and what rules are changing about pensions from 1st of July. And we're going to talk about quite a few issues here. The issues which we're going to talk about is the balance transfer cap, which is going to be implemented from the 1st of July. Basically, the legislation talks about if you have assets more than $1.6 million in pension phase or in retirement phase, the new word, that asset will earn some income, and that income will be taxed at the normal tax rate of 15%. Now we'll talk about some excess transfer balance penalties, because you may uh, or your clients may have existing pensions which have more than 1.6 million. You get up to 7 months till 31st of January 2018 to fix that, but only up to $100,000. So we're going to talk a little bit about that. But I'm going to concentrate mostly on the issue of CGT, cost-based relief, and that's been a little bit of a concern for many practitioners. And still we are waiting for some part of the legislation to pass through Parliament. They were fixing a few things, but it's not everything has not become law. But I'm going to talk about how it all works with one example, and I'm sure you will have very complex situation in your own database of your clients who have pensions over 1.6 million. I'm going to talk about transition to retirement issues and the removal of tax benefits. So from 1st of July, if you have a client who wants to continue a transition to retirement pension, then he will be able to withdraw the minimum and the maximum amount from his self-managed super fund, but that TRIS will not be in retirement phase, and if it is not in retirement phase, it will be subject to 15% tax. Uh, if your clients have more than 1.6 million, then they will be moving that amount outside the retirement phase. And outside the retirement phase is the accumulation phase. And in accumulation phase, they'll still be able to withdraw money if they are not working. Um, and if they are below 65, so they will be able to withdraw lump sums. But if they're over 65, even if they're working, they will be able to withdraw lump sums from the accumulation account. So nothing much has changed as far as the minimum pension requirements is concerned. Now, when we move money from a pension account into accumulation, or vice versa, that is from an accumulation account into a pension account, it is basically called an internal rollover. But when we move money from a pension account into an accumulation account, it will be a commutation of that pension, and it's an internal commutation. And I'm going to talk about what is the procedure on how to move money from a pension account into an accumulation account, and some strategies. So let's get cracking. Let's just talk about what is 1.6 million first. So basically it is introduced because If people remember in 2006 when Peter Costello said that yes, you can put as much money as you want in your self-managed super fund, you can put 1 million maximum, and whatever you withdraw after the age of 60, uh, uh, any amount in the super fund in the pension phase would be tax-free. So later governments have realized that making it tax-free, and over the last 10 years, everybody has contributed quite substantial amounts of deductible and non-deductible contributions cannot last forever. So what they have done is they basically limited the amount of earnings that could be exempt from income tax. So that's the biggest problem which we are going to face. The other day I met a friend of mine. His super fund, his self-managed super fund, is about 15 to 20 million dollars, because some of the properties he doesn't know what the values are. So imagine for him, out of the 17 million, only 3 million would be moving into what is now going to be called retirement income phase. So the remainder 13 to 15 million dollars would remain in the accumulation phase. So for him, something like 75% of income would be taxed. So that's why the new legislation has been introduced. Now we know that the balance cap is 1.6 million for 6, 17, and 18 years, and will be indexed by $100,000. And the way we are looking at the CPI prices going up, I don't see that it's going to happen till the next 5 years, unless the legislation, of course, changes. Yeah. Now, what we are supposed to do, we are supposed to track not only the member accounts, but we are also supposed to track um, the balance which is going in and out of the balance transfer cap amount. So it's basically a system where you will have debits and you will have credits, and that's what you need to do. And obviously you will be thinking, how am I going to do that, because my system does not allow me to do that. You could be running class or BGL, but I'm hoping that those systems would be upgraded, and your member statements will not only talk about how much is taxable and tax-free components, but it'll also talk about what is your current balance of your balance transfer cap. Now, balance transfer cap moves very differently to the superannuation interest, because the balance transfer cap is 1.6 million on 1st of July for that financial year. And in the future, if your assets grow in pension phase, you may have a higher income stream, and if your age increases, you might have a higher withdrawal amount, percentage amount, but your balance transfer cap amount has got separate debits and credits. And basically super interest, when it commences a pension, would be credited to your balance transfer cap amount. Now if you have, say, only $1.2 million currently in pension, if you contribute more money, that again, so any new super income streams which you commence after 1st of July will also be credited to your balance transfer cap. Now, if your spouse is also in your self-managed super fund, and if one of you dies, then any amount coming to you as a revisionary income stream according to your pension arrangements will also credit your balance transfer cap. Now this will have some estate planning issues, and if you can look out for some of our webinars which we are going to hold, we're going to talk about on how to manage these reversionary income streams coming to you, and how we can ensure that we do not breach the balance transfer cap amount. Now what is debited is, say, if you commute a pension, so today you may have $1.6 million, and 2-3 years later on your amount goes up, and then you commute a part of that pension, so that will debit your retirement income stream. And any payment, what you need to remember is any pension payment is not a debit, it is only the commutation, unless there's a personal injury structured settlement, which is very rare, so we're not going to go into that area much, but we're just going to talk about any commutation will reduce your retirement income, and that will actually reduce your balance transfer cap. Now, if you have more money in your the pension phase, then you obviously breaching your transfer cap amount, and you have two consequences. Basically, what you need to do is you're required to commute the pension and move it into retirement phase. What you can also do is you can remove it from superannuation altogether, and you can withdraw and keep the money outside your super fund. Now, if you decide not to do that, we're talking about any income which is earned by any amounts above the transfer balance cap to be taxed at the highest tax rate, which is the excess transfer balance notional earning of the pension of the income stream, which is going to run in the self-managed super fund. Now, it is highly recommended not to go over the excess amount over 1.6 million, because if you move into accumulation account, you will be paying tax only at 15%. But if you go over the excess amount, the highest tax rate we're looking at is 47%. Now, I'm noticing that some of you are probably not able to hear me. I'm repeating myself. There is a phone number on your panel, and the only way you can hear me is by clicking that phone number and then entering the webinar number, and you will be able to hear me just on your phone. Okay, now moving forward, let's talk about, and this is the main reason why we have this webinar today, is about the CGT, cost-based relief, what it is and who is it for. Now, if you have a member who is in pension phase, so he must be in pension phase, and he must have 1.6 million or more. So if you have a member who has only 1.2 or 1 million in pension phase on 1st of July, then you don't have to worry. So you can basically log out and you're done. You don't have to worry about it at all. So if the balance is 1.2 million on 1st of July, and if it grows later on to more than 1.6 million, you don't have to worry about that either. So you're talking about only for those funds which have more than 1.6 million in a self-managed super fund, which we are going to talk about, and that person must be in pension phase. Second thing is that where it will be, or who will be affected is all those people who want to be in transition to retirement pensions, and they want to continue this transition to retirement pension on 1st of July 2017. Now, I'm just repeating myself. If you continue your transition to retirement pension, the minimum pension rules will apply. You will be required to withdraw the minimum amount, and the amount which is supporting this transition to retirement pension in the super fund will, from 1st of July, pay tax at normal rates. So we are talking about situations where the member has reached the preservation age, but they are not retired, they are still working, and the pension is not an account-based pension, it is a transition to retirement pensions. Now, if you have clients who are not in pension phase or on TRIS, or they want to stop the TRIS on 1st of July, then you don't have to worry about the CGT relief, and because it does not apply to you at all. And if you move the transition to retirement into accumulation phase, again, these provisions do not apply to you. Now, the legislation to look at is the law companion guidelines which the ATO has issued, and the memorandum, the information memorandum of the new legislation. But basically, you're looking at LCG 2016/8, and it details what the transfer balance cap is and how the transition to retirement reforms and the CGT relief works for self-managed super funds. Now, I keep on repeating self-managed super funds, but it would apply to public offer funds as well, but I believe most of the audience here is worried about the self-managed super fund. So the balance transfer cap from 1st of July, the accumulation phase goes into pension phase, the tax-free retirement, 1.6 million. So any amounts which are above the 1.6 million, you can withdraw the excess amount or you can commute the excess amount. A commutation basically means that it is a pension, but the pension is given certain other conditions, and those conditions are that you're not withdrawing those money, so it is still your superannuation interest, but it becomes something else, and that something else is basically an accumulation account and what we call as internal rollover. Now, uh, when you have a transition to retirement pension uh, after 1st of July, and any income on transition to retirement will not be taxable, will not be exempt from tax. It will pay tax. So CGT will apply to those amounts as well. So we have to be very, very careful whether the transition to retirement has to be continued or not. And if it is not to be continued, then obviously you'll have to commute that transition to retirement pension. Now, the transitional CGT relief, the funds are only exposed to future growth in the asset value from that point. So if just a very simple example, in 2000, say 5, about 12 years back, your fund bought a property, say for $1 million. On 30th of June, it is valued at $2 million. Now, the 1 million, and you have been on pension phase till 30th of June, the 1 million growth will be the relief, the CGT relief, and any growth over the 1.6 million amount would be proportionate. And I'll talk about what is proportionate in a moment. Now, you were able to segregate certain assets and you could pinpoint certain assets belonging to a pension phase, and any income from those assets was tax-free. Now, from 1st of July, you will not be able to segregate those assets. And I'm going to talk a little bit about that with a picture so that you understand what exactly is changing. Now, the intent of the new rule is to make sure that you don't go and sell everything while you are in pension phase before 30th of June. If you sell everything before 30th of June 2017 because you're in pension phase, then everything would be tax-free. So if you get that relief, a paper relief that you're not going to pay tax on that amount, then you would not need to sell those assets. So basically what we are doing is we are resetting the cost base. So instead of that property bought for 1 million in 2005, your cost base will change to 2 million on 30th of June. So basically what you're doing is, if there is an asset which was bought prior to that, and that asset is no longer going to be in the 1.6 million, or it's going to be over and above. If your balance is more than 1.6 million, because it has grown 1 million in pension phase, you will get that relief because your balance is more than 1.6 million. Any amount above the 1.6 million falls out of the retirement phase, it falls into the accumulation phase, and any income from there on would be proportionately taxable in the fund. So assuming that you have a $3.2 million dollars and only 1.6 million goes into pension phase, and you bought the asset for 1 million in 2005, up to 30th June, if it has moved into 2 million, but going forward from 2 million, if you sell the asset 5 years from now, say for $3 million, the $1 million extra gain, because on 1st of July, you had 3.2 million, 1.6 million has moved into the accumulation phase. So $500,000 would be tax free, and $500,000 will be taxable, because that is a 1 million growth after the 1st of July. But any growth before 30th of June would be the CGT relief, what we are talking about here. Now, this relief is not automatic. The trustee in the super fund must choose for the relief to apply. And what is being proposed is an approved form. And there has been a talk that this approved form would be the tax return, and the tax return will have a new CGT schedule, and you will have to note what is the cost price of the asset and what is the market value of that asset on 30th of June 2017. Now this election is irrevocable. Once you have decided to take that relief, it will continue, and the cost base of that asset will move to the market value. So basically what is happening, that asset would be considered that it is sold and you have repurchased that asset at that market value. So the asset which you bought in 2005 for 1 million, on 30th of June it is 2 million. So on 30th of June it will be considered that you sold it for 2 million and your new cost base will be 2 million. Now one thing you have to remember, because you bought it on 30th of June, any further sale, because you actually bought the asset in 2005, it's been 12 years that you've owned the asset, the CGT discount, any further income above the 2 million will be again subject to the 12-month rule. That means that if any sale happens, because your cost base has changed, your date you have acquired the asset has also changed to 1st of July. So the 12th month rule will apply from 1st of July 2017 onwards. So if you have clients who are thinking of selling, you must alert them that once we move into the next financial year, if they want to avail the 1/3 discount, they have to consider the date when the asset uh, is actually sold from 1st of July to calculate any further CGT discount. Now let's look at an example, and through a picture you'll understand what exactly we are facing here. So let's say the asset was purchased in 1997 for 1 million, and it has become 2.6 million on 30th of June, and this is a one member fund with only one asset, just to make it very, very simple and easy to understand. Now, for our example, we are saying that the asset will be sold after 3 years for 3.6 million. So there is a growth of 1 million from today's date. So it has grown from 1 million to 2.6 million, which is 1.6 million growth. And from this date onwards, it has grown for another $1 million. So uh, on 1st of July, what would be considered? So this is a day, you lose one day, and they're going to fix that one day by new legislation. Because you have 2.6 million, we are assuming that you would be moving 1 million, and all the 2.6 million is in pension phase. We are assuming that 1 million out of this 2.6 million would be commuted and moved into accumulation phase. So you will have on 1st of July the whole amount, because it is only one pension, the whole amount, the whole pension has to be commuted on 1st of July. And on 1st of July, you will commence a new pension, and that pension will be for the transfer balance cap of 1.6 million. So what is actually getting commuted? If you have one pension of 2.6 million, that whole pension is being commuted. Now, if you have a fund which have multiple pensions, 3 or 4 pensions, you can retain 1 or 2 pensions amounting to 1.6 million. Now, there's one more thing. You don't have to credit your balance transfer cap amount with the full 1.6 million. You can even credit your balance transfer cap with any lower amount. You can have 1.5 million in balance transfer cap, 1.2, 1.3, any figure. But if you want to maximize or reduce your tax on income, you would be maximizing your pension amount on 1st of July. So on 30th of June, you have 2.6 million. On 1st of July, you commute this pension. And once you've commuted the pension, the full amount moves into accumulation. And on the same day, you commence a new pension. Now, when you commence a new pension, that amount can be any amount under 1.6 million, but it cannot be more than 1.6 million because that is the maximum amount which is allowed to be transferred into the transfer balance cap amount. Now, we have two items here. We have transfer balance cap of 1.6 million, and we have a situation that some assets are now, or because we have only one asset, so that same asset is partly now in accumulation phase. So now we are selling the asset, so we continue from 1st of July in, and then continue holding that asset and earning income on that asset. While we are earning income on those assets, because we now have an accumulation account and a pension account, you will need an actuarial certificate which will determine how much income is tax-free and how much income is taxable. Now, the pension account can move up and down. Like I said, you can credit the income if the asset is earning, say, $260,000 rent, then the pension account will be credited with the income, and whatever pension payments are being made, that will reduce your pension account, but not the transfer balance. That is a separate account altogether. So it is possible that when the asset is sold, you may not have the exact amount in your pension amount. That means that because of the withdrawals and the income credited, it is possible that you will have a different amount. So here you can see that the actual purchase price is 1 million and the selling price is 3.6 million. The actual capital gain is 2.6 million, but the taxable gain is only 1 million. The reason why it is 1 million is because of the CGT relief. And the amount of tax which you will pay would be, this is just an estimate. What I've said is because 1.6 divided by 2.6 is the proportion on 1st of July, but that may not be the proportion on the date when the property is sold. So it is possible that you may contribute more money, the accumulation account can go up, and you may withdraw a lot of amount from the pension account as a pension. So your amounts will differ, but this is just an approximate. So basically 1 million would be taxable, and that tax-free gain would be the balance amount. So whatever is not taxable, the remainder amount will be tax-free. And this growth from 1997 to 2017 will be basically the relief which you will get in your calculations. Now there are 2-3 methods on how we can handle it, but basically uh, this situation is very simple. We, as you know, can have 4 members in the fund and we can have many assets. So uh, in this case, we are assuming that the election is being made for that one asset in the fund, but things can get complicated. We can have multiple assets, and it is possible that some of those assets on 30th of June could be basically below the cost price. That is, it must be the market value is lower than the cost price, and it's complicated because then then only those assets can be elected for where they have actually increased in value. Now, different rules will apply to assets which are segregated for pensions, and different rules will apply for assets which are unsegregated. And I'm going to explain what is segregated and unsegregated because it can be a little bit complex, because you could segregate certain assets for certain members because that's your investment plan. But segregation here I'm talking about is segregation to the pension account. So that means a particular asset is put in a pool of assets. So where some assets are absolutely marked as if they are pension assets and they belong to certain members who are only in pension phase. Now, there are very few funds which are run on segregated basis because many funds, many self-managed super funds are just are run on unsegregated method. And what unsegregated method means is basically all the assets of the fund belong to all the members of the fund. So the same asset is shared by some members who are in pension phase and by some members who are in accumulation phase. Now, section 294-110 is repealed. So what that means is from 1st of July onwards, segregation in a self-managed super fund is not allowed. So what that means is that if an asset has been segregated, kept aside, put away in an asset pool for a pension account, that may not be allowed anymore from 1st of July 2017. Now, just to understand what segregation is, let's have a look at picture number 1 here, where they have achieved 100% segregation. So basically, there are two members, and all the assets of the accumulating member, or there could be four members, so there could be three members who are in accumulation and only one member in pension phase. So all the assets are segregated. That means all assets belonging to accumulating members are separate, and even the bank account is separate, although it's not necessary, but that's an issue for another day. So we are basically running two funds within a fund. So we have segregated assets, and they belong to only that particular member who is on pension phase. Now, you can also have a situation where you have partial segregation. So what partial segregation means is there are some assets which are segregated and some assets which are accumulating assets which are segregated again, and there are some assets which are mixed. That means some belong to pension members and some belong to non-pension members. And then we could have a third type of segregation, that is, we have some assets belonging only to accumulating members and some assets which are mixed, that is, they belong to pension members and they belong to accumulating members as well. Now, an example of an unsegregated asset is basically all the assets are put together and they belong to all the members in proportion of their balance. Now, this concept is sometimes very difficult to understand because you must go back to your accounting theory. We always talk about assets and then we go back and talk about member balances. Now, the reason why we do that is if you look at the accounting background in a balance sheet, we have debits and we have credits. So in a self-managed super fund, all your debits are your assets and all your credits or most of the credits are your member balances. You might have other credits, let's say PAYG owing or tax owing, or if you have a loan, if the self-managed super fund is borrowed. So there could be other credits as well or liabilities of the fund. But basically the liabilities are the monies which the trustees owe or the member balances of each and every member. So we actually don't segregate the member accounts. We just keep them clubbed, but it is segregating that particular asset. The reason why we segregate that particular asset, because all income of that particular asset could be tax free, and there are strategies which advisors put into place where higher income assets are specifically, or higher income or higher CGT assets are particularly segregated for that particular member who's on pension phase, just to reduce the overall tax. Because if that asset is mixed or it is unsegregated, and if that asset is sold, the capital gain would be distributed with not only pension members, with also with accumulating members. Now, going forward, so we understand what segregated assets are. So if we transfer, if the asset is removed from that pool, and you're allowed to remove from that pool of segregated assets from 9th of November to 30th of June, and then once you remove it, you must have the market value. So the date when you move it is very important because that will be your deemed sale and acquisition date at that point. And once it is moved, it goes into the unsegregated pool, and then any income. So if you wanted, you could even move the asset on today's date from a segregated pool to an unsegregated pool, and any income from 18th of May till 30th of June would be on unsegregated basis. Now, the deemed sale of the market value occurs as part of the exempt pension asset, so capital gain is ignored because what you're doing is you're basically removing from the pool and you're putting it from segregated asset to an unsegregated asset. But after the move, so let's say after the 18th till the 30th of June, it will be subject to tax because if you have accumulating members who are paying tax, that income of those assets will be included with the other assets which are in the mixed pool. Now, just to show you in a picture, so here we are, we have a fund and we have some assets, we have two properties and they're segregated pension assets. So what we are doing is basically we can transfer from the 9th of November to 30th of June. So what we are doing is we are just putting it into the accumulation phase, and we are just getting ready for moving our assets, and we're just retaining one of the assets which is probably going to continue and probably less than 1.6 million into the pension phase. Now, the unsegregated asset, which is most of the fund, the sale will happen. It cannot happen like I discussed between 9th of November to 30th of June for segregated assets. The unsegregated assets, there is no choice. Everything will be deemed to be sold on 30th of June. So you cannot pick a date, any date between 9th of November 2016 till 30th of June. So the valuation date is going to be the 30th of June. So when you prepare 30th of June accounts for your clients, it is very important that you get the correct valuations. Now, as far as valuations of securities is concerned, it is pretty straightforward. But when you come to value properties, you have to be extra careful on what valuation you have to use, because that valuation will determine how much will be credited into the pension account. So you could call it as a double barrel gun, because if you value the property high, then any future gain will be, capital gain would be reduced. But if you value it high, the problem would be is that it will take over most of the balance transfer cap of 1.6 million. Now, if there is a gain, then it may be included as part of your 30th June assessable income. So what we are trying to say out here is that if you want to pay tax, you have the option to pay the tax. So let's say the asset was bought in 1997 and the asset has now become from 1 million to 2.6 million. There is 1.6 million of gain, and if there are accumulating members in the fund and pension members in the fund, then we can work out the amount of tax based on the members, based on an actuarial certificate, on an actuarial determination on how much tax would be due in the financial year 30th June, and we can pay that tax. But we don't have to pay the tax. We can defer the notional capital gain until the asset is actually sold and CGT is actually realized. So we can hold on to that notional capital gain, so that 1.6, so you bought it for 1 and today it is 1.6, so you don't have to pay the tax on that 1.6 million gain. Now I'm assuming that there are other members who are in accumulation account, because if you sold it now, physically sold the asset, it will be all CGT free because all 2.6 million is in pension phase. So the date of acquisition and applying the 1/3 discount will also be reset. I'm again repeating that. So your date of acquisition, because it's been reset, it is deemed sale and a deemed purchase. And your deemed sale and your deemed purchase for unsegregated assets will always be 30th of June. Now, what we are looking at is we have to document each and everything, and we're looking at on lodgement of the 2016 and 17 annual return. So let's say 15th of May 2018 is the date when you will lodge the 30th June 2017 return. That approved form has not been actually discussed or been talked about, but it has been somehow conveyed that the 2016-17 tax return will look very, very different, and it will have this election, which is irrevocable election, and full details would be provided in that form, and the CGT market value would be disclosed on 1st of July in that tax return form. Now, as far as segregated assets are concerned, basically, we are not doing much. The important point to note here is the deemed sale is happening on 30th of June, and all assets are moving into the 1st of July mixed assets. They were already in mixed assets, so they're just moving into the mixed assets for all members on 1st of July. But the sale price is the 30th June, and that is the cost date as well. Now, would you need any action? It will all depend on what type of clients you have, what type of self-managed super funds they have. But if you just take this point that if you have an account-based pension client, at least one member is in self-managed super fund. So if all your clients are in accumulation phase, you have nothing to worry about. And when they move into the pension phase, let's say 2 or 3 years later, we will be looking at their CGT amount at that point of time, and all that would be at market value. Whenever you can commence a pension, you always do a set of accounts, and then whatever is the unrealized gain, that is credited to the member account, and once it is credited to the member account, only 1.6 million will move into pension funds. Now, the options, any actions required is to commute some or all of their pension account to accumulation account before 30th of June or on 30th of June. So if you want to move into accumulation phase, you will have to remember commute the whole pension. But if your client has multiple pensions, then you will be commuting some of those pensions, and the other pensions can continue past 1st of July. And option number 2 is you can actually withdraw some of the amount, so that when we move on 1st of July, that member does not have more than 1.6 million in his self-managed super fund, in his superannuation interest, in his superannuation balance. Now, the second situation where you will need some sort of an action is where there is a transition to retirement which was commenced before the pre-commencement date, before the proposal was put in the budget, which is 9th of November, and and you want to continue that pension. You want to stay with that pension, and if you stay with that pension, you actually going to lose any tax exempt treatment. So assuming you were in transition to retirement pension, you want to continue that transition to retirement pension. So let's say the asset was bought again for 1 million, but it has moved into 2.6 million, and you want to continue that pension. You want to ensure that $1.6 million growth remains in pension phase. Only then you need to take this action. Now, if the pension moves into, if the member moves into account-based pension, he is no longer in a trust situation. So the only change there would be is that any income up to 1.6 million would be tax-free, and the amount above the 1.6 million will again move uh, into accumulation account. So basically, there will be quite a few situations, quite a few of your clients will be finishing up with their transition to retirement pensions and starting an account-based pension. And there is a talk about how will that happen? How, will it be automatic? Will will a transition to retirement finish automatically on 1st of July? And would an account-based pension commence straight away? I feel that a transition to retirement pension is very similar to an account-based pension, but the SIS regulation 1.069A imposes two limits or two situations, that is the maximum amount of withdrawal and the non-commutation. So what a member should do is basically write to the trustee to say that he's no longer working on full-time or part-time basis, and I'm going to talk a little bit more about that. And since I am now retired, I have met a condition of release according to Schedule 1 of the SIS Act. So I should convert my transition to retirement income pension into an account-based pension. A simple letter and acceptance of that letter in a minute by the trustee would be sufficient. Now, if you're buying documents from trustdeed.com.au, we have provided those kind of letters, and you can simply download those letters. We call them admin documents. So if you have purchased a Superfund trust deed from trustdeed.com.au, just log in into the document manager, and in the document manager, in the finished paid documents, you go into admin documents, and those computation letters are there. Now, we're just talking about funds which are paying account-based pensions and transition to retirement pensions. We are not talking about defined benefit pensions. There are some funds, a small number of funds, which are continuing to pay defined benefit pensions to their clients. And as you know, you cannot commence a defined benefit pension in your self-managed super fund anymore. So I'm not going to discuss those situations. Now, going forward, what you need to consider now, whether or not you should take that election, whether you should, look at whether this will apply to your client or not. If you're a trustee of your client, what are the things what you need to consider? So the first thing you need to consider is that is your balance more than 1.6 million. So that's like one of the first things which you will consider. The second thing is whether your assets, the way you claim your exempt current pension income, whether the assets are segregated or not segregated. And the next thing, which is very, very obvious, is whether there is a capital gain or not. It is possible that your market value is below your cost price. So there is a capital loss. So as far as capital loss is concerned, there is no relief available to that. Basically, it continues till you actually realize that loss, and then in future years, you can claim that capital loss. So we are talking about situations where only if market value is more than the cost price. The next thing is that if you're thinking of disposing that asset, so after 12 months, so from 1st of July 2017, if you're thinking of selling that asset, whether you should take the election or not, because if you do sell within the 12 months, you will not get the 1/3 discount. Now, before, now a super fund could have many assets. So it's possible that some assets are likely to increase in value in future, or it could be an asset which may not increase in value in future. So you have to, before you make an election, think about whether it will really affect you or not, and whether the election is good for you or not. Because if the value has gone up, it is possible that in the future it may not go up. Now, what is the ECPI percentage of the super fund which is expected? So it is possible that there could be members moving into pension phase. So you may have a situation where some members have not reached the preservation age, or they have reached the preservation age but they have not retired. So it is possible that you don't take the election, because if you elect, then you got the CGT relief and you still end up paying tax. So it is possible that if the member is going to, other members are also going to move to pension phase, so it will be probably ideal to do nothing and then sell the asset when all the members are in pension phase. Now that is only possible if both the members are below the balance transfer cap of $1.6 million each, so that all the assets remain in the pension phase and do not pay any tax on CGT. And I'm going to talk about in an example about that. Now, members with transition retirement pension, they have to be very, very careful whether they meet a condition of release or not, and whether we can convert the transition retirement pension into a simple account-based pension. Now, many members, husband-wife situation, one person is 5 years older, 10 years older, so it is possible that when we move into retirement, the other member. So in this situation, we have one member who is got 2.2 million and is above the preservation age and is retired, whereas the other member is got only $800,000, but but that member is in accumulation phase. Now, it's possible that after 2 years, this member moves into the pension phase. So what we need to do is we need to consider whether we should withdraw now the excess amount, which in this case is $600,000, and contribute that $600,000 into the accumulating member now. Now, if you do that, then it is possible that this member will have 1.4 million and this member will have 1.6 million. So the whole fund after 2 years could move totally into pension phase. So these are the things which you really need to think seriously. To understand this, let's have a look at an example. Now I know you have some questions, and I can see quite a few questions have been put up. What I would do is I'll just finish my presentation, which will end in about the next 5 or 10 minutes. And those people who want to leave can leave the webinar, and those people who want to know the questions and the answers which other people have put in can stay on. Now let's look at a situation. They're two-member fund and the value is 3 million on 30th of June 2017. Henry is 62 years old and he's retired, and he's on pension with 2.2 million, and Martha, his spouse, 58 years old, working, not retired, above the preservation age but not on transition to retirement, but she's in accumulation, and $800,000. The fund has purchased a property some years back for 2.25 million, and the value of that property has gone up to 3 million, and there's a 750,000 notional gain. So he has 2.2, she has 0.8 million. The asset which was purchased for 2.25 million has now gone up to 3 million, and the two members have 3 million together. So what we have to do is we have a situation where we have to move 1.6 million, that is Henry's 2.2 million. We have to transfer 1.6 million into the pension phase, and Martha, who has 800,000, sorry, this should be Martha. So 800,000 and Henry's extra 600 would be in accumulation phase. Now we all know that to balance it off, Henry can actually withdraw 600 and hand it over to Martha. But we could have a situation where Martha herself has 1.8 million, so that would be a different example altogether. So there is no possibility to add more income to Martha. So we could have a very different situation right here. So let's look at the options, what options we have. We can sell the property now and just pay the CGT, because Martha is on accumulation, so there would be some amount which would be paid in tax. Now we have a second option. What we can do is we can reset the cost base on 30th of June, and if we reset the cost base on 30th of June, we can make an election in the tax return, and we can even include the notional tax in the tax return. So we can pay tax. Because Martha is on accumulation, there would be some tax. So it is possible that we could just pay that tax in that year. But if we don't want to pay that tax in that year, we can defer that tax till the actual asset is sold. So we can take that election and we can claim the CGT relief of 750,000, but we don't pay the tax as in option 2, but we sell, but only when we sell the asset. And the fourth option we're going to talk about is that if Martha is going to retire in a couple of years, she's 58 years old, what would be our tax situation? So let's look at those examples. Number one is very clear. We just simply pay the tax. So what we're going to talk about is number two, where uh, number two is exactly with number one, but in number one option, we are basically selling the asset, but here we are deeming that it is sold. So there's very little difference between the two. So in option 2, there's a notional CGT which is included in the tax return. So the gain is 750, one-third discount which is 250, the taxable discount is 500, and the exempt portion is 2.2 by 3 million, which is 366. The assessable income is 133,000 and 15% tax is paid. So basically what we are doing is we are paying $20,000 tax. We are including $20,000 in the tax return. Now option number 3, what we are doing is we are not paying the tax. We're going to pay the tax till when the property is sold. So now let's assume that the property is sold for 4 million and in the future in 2020. So the cost base was reset to 3 million and the selling price is 4 million. So the CGT is actually 1 million. Now, if you remember, the CGT is 1 million, but there was notional of 750,000, and part of the notional, if you remember, the assessable was 133. The reason it was assessable is because as on that date, Martha was in accumulation. So when we go to look at this deferment, the 1 million, the situation has now changed. The reason why the situation has changed is because from that date onwards, from 1st of July onwards, Henry, only 1.6 million can go into pension phase. So the gain is 1 million. We get the one-third discount. So the taxable CGT is 666. But we are assuming that Henry's portion has gone up. So he had 1.6, but it has gone up, and the new balance is 4 million because the asset value has gone up. And this is just an assumption because the assets is sold in 2020. So it's possible that that the member has withdrawn, Henry has withdrawn money, or the income from the asset has actually increased the balance. So it's very difficult to actually uh, put a figure to it. So we have to assume that half of it is in pension from that date onwards, and the deferred amount, the amount which was the gain because of that 750,000, the amount which has actually gained in the prior period while Martha was on pension, that has to be added. So these two amounts get added, and again 15% is taxed. Now the only thing is that we will be paying 75,000 later on. So the additional income, which is 1 million, because that person has remained in accumulation, or some of the money has gone into accumulation, would actually increase this tax amount. Now, I would suggest that you look at these examples again. I will email it to everyone. You will get a handout. You can, when we upload this seminar, we will give you the presentation and you'll be able to work it out. What we actually do is after the presentation, after this webinar, we go to Financial Planning Association, we hand over this presentation and the notes which I use, and then get it checked for the number of hours the CPT would be allowed. Once we get that approval, we then upload this seminar, upload this webinar on the website, and you'll be able to view it at any time and download these notes at any time. So moving forward, let's look at option number 4. If Martha is to retire and the property is then sold. So in this situation, so the selling price is 4 million and the assets in pension phase is 1.6. Now again, we are assuming that there is a growth in the pension side, and Martha at 1 million again, we're just assuming, and there is a growth in that asset, and the total value is 343. And then Henry had an accumulation account which also grew in value. Now because of the 1/3 discount, then we have to look at the exempt component, because Henry is still in pension phase, and you multiply that by the approx percentage. Now again, this is an assumption because we don't know what Henry's account and Martha's account, after Martha moves into pension, what those figures would be. So let's just assume that it is 86%, or we can say that the actual growth is 1.75 million because the asset was sold, because 2/3 would be the discounted gain, and then 86%. So that we were trying to work out what the future value of the fund would be and how much would be in accumulation or pension. So the problem is that we don't know when and at what value will you actually realize the asset for, and it is very difficult um, to make an election which option would be the best for your client. That's where the problem is. And the other problem is that this election is an irrevocable election. So if it looks differently from the future, when the figures are actually comes out, because when you actually realize that asset. And the other problem we are facing, and it's a practical problem, is the valuation of the asset. And if your clients have property, you've got problems straight away, because valuations could be very different. And if the properties are in major capital cities, we all know the values have gone up quite dramatically in the last 3 or 4 years. Anyhow, moving forward, we did consider option 5, that is withdraw the excess amount, but uh, please note that this option should be taken before 30th of June, so you've got very little time here. So if you have clients who have more than 1.6 million and their spouses have lower values, so we're talking about Henry's excess over the balance transfer cap. So he's got 600 extra, and we add that in the accumulation account, and we make that 1.4 million. The benefit of this option is that when Martha goes into pension, then the whole fund actually is in pension, because even if after 2 years her balance increases from 1.4 to 1.6 or below 1.6, it is possible that the whole fund can remain in pension phase. So I would consider this option to be the best option. If you have clients who have this disproportionate member balances, this is the time to fix it. The only challenge is that if you have members who are over 65 and they are not working, so you cannot contribute, a member cannot contribute if they are over 65 and not working. The other challenge you have is that if your members are over 65, the bring forward rule does not apply. So if your clients are under 65, the bring forward rules do apply, and before 30th of June, you can actually contribute $540,000. In our case, Martha was 58 years old, which is below 65. So this figure of 600 is actually incorrect, because the maximum amount what she can contribute non-concessional into super would be $540,000. Now what the strategy would be in that case is you contribute 540, and next 3 years you cannot contribute anything. So you will be holding 60,000 outside of super, and after 2 years, the next 2 years, the maximum non-concessional contribution which you can contribute is $100,000, but that also is controlled by how much superannuation interest you have. and if your balance is more than 1.6 million, you cannot contribute anything. So if you hold 60,000 outside, you check the balance after 2 years and see if it is more than 1.6 million or below 1.6 million to contribute back into super, or just hold the money outside. Now, as you can see, you would need actuarial certificates, and this is a new website which we have launched. It is fully functional now. If you buy a pack of actuarial certificate, I think it's $100. If you buy one, it is still $97.50. But if you buy 100 actuarial certificates in advance, the cost per certificate is only $55. If you, and these packs never expire. So if you do 50 funds, if you need 50 actuarials, if you buy a pack of 100 actuarial certificates, then they will last you 2 years and the cost will be reduced to $55. This we've been able to achieve because we have developed a new, through MVC, Microsoft system, a double check where the actuary is actually prompted if there are any errors. So it takes very little time to issue these kind of certificates, and the reason we've been able to achieve that is because of technology. And we strongly recommend, if you're buying certificates via your accounting function, accounting programs, consider saving some money. And if you use this software, you just have to add a fund once, and every year you will be able to order actuarial certificate. It should not take you more than 2 or 3 minutes to order an actuarial certificate. And also to remember that you cannot use the segregated method anymore. And on retirement phase, if you have one member who is on pension and accumulation, you will need an actuarial certificate. And when you start an income year in the next year, if your total super balance is more than 1.6 million, it's quite possible that you will have the same member, even if it is one member, if being in accumulation phase and being in pension phase. In those situations also, you will need an actuarial certificate. We are assuming, because there were about 20% of funds, about 100,000 funds, only in accumulation or only in pension phase, it is possible that these funds will now need an actuarial certificate. Maybe about 10% of them, they would have about a balance of more than 1.6 million. So uh, you you would need about 50,000 more in Australia. All in self-managed super funds will need at least 50,000 more certificates than previously. Now, let's talk about TRIS. What is a TRIS? It's basically an account-based pension, which has two problems. That is the condition of release. You cannot withdraw more than 10% and you cannot commute a pension. And Schedule 1 has item 110 talks about when can a TRIS move into pension page or when can you commence a pension. It's basically based on your preservation age, and the cashing restriction is the 10%. Now, if you meet another condition of release, so if you are in transition to retirement pension and if you turn 65, you don't have a condition of release, which means that you can withdraw more than 10% or the whole amount if you want once you're over 65. Now, if you have a TRIS, you have three options. Basically, you can commute the TRIS, you can move into accumulation phase and you pay 15% tax on income in the fund. But if you want to continue the TRIS, you have to withdraw the minimum amount and you will pay 15% tax on income. Now, if you pay 15% tax on income, it's possible that you salary sacrifice and contribute into super, so you will need money to live on. So for those people, I think it is recommended to continue the TRIS. There is another option. You can decide to retire, and if you retire, the transition to retirement pension will move into retirement phase, and once you are in the retirement phase, and if your balance is below 1.6 million, then um, then TRIS, any income supporting the TRIS amount will not pay any tax. Now there is a new concept of the retirement phase, and we're talking about section 30780 of the Tax Act, and the income stream is in retirement phase when it is being paid. And basically you have not met, it's not a deferred, so there's a condition of release which has been met, and the pension has actually started being paid. But if you are in transition to retirement and you're not in retirement phase, that means the amount is still taxable. Any income which is supporting that pension, if it is still taxable, if it is not exempt, if it is still taxable, then basically you're not in retirement phase. Now, how can a transition to retirement pension become account-based pension? It's very simple. You should not be working, and you should be retired. And retirement is very difficult to understand, and I'm going to go through that definition of retirement. But once you're 65, which is item 106 of Schedule 1, which is here, so you don't have to worry then, because then the TRIS will automatically become an account-based pension because the condition of release, another condition of release has been met. So to look at the definition of retirement, we have to go into SIS regulation 6.017, and what it talks about is for members who are less than 60 and for those members who are over 60. So those who are under 60, they should have the arrangement under which the member was gainfully employed has come to an end. So they should have finished work, and the trustee should be satisfied that they don't intend to go back into full-time or part-time work. Now, I've underlined full-time and part-time because I'm going to define what is full-time and part-time very soon. Now, if you're over 60, then both the conditions are not relevant, because if you're 60 and you are 60 and you have ended that employment on or before the ending of the employment, then the trustee intends never to gain. So the trustee has to be satisfied that you don't want to go back. So only one of these two has to apply. So if you're 60 and you don't want to go part-time or full-time, then basically you have retired. And if you have retired, then transition to retirement does not apply. Account-based pension applies. And if account-based pension applies, then you are in retirement phase. And if you're in retirement phase, any income supporting that pension will not pay tax. So let's just look at what is full-time work. A full-time work is someone who works at least 30 hours each week. What is gainful employment? You should be working. If you have rental income or dividend income, then you're not considered gainfully employed, so you're not working. What is part-time? Part-time is gainful employment for at least 10 hours. Now, I'm just going up there. So the definition here we are saying is that the person intends never to again become gainfully employed either on a full-time or part-time basis. So you're not becoming full-time. That means you're not going to work 30 hours and you're not going to work for at least 10 hours and less than 30 hours. So anything less than, so what this implies is anything less than 10 hours is basically retired. Now, just you have to watch out here, because you might be thinking that I have a client and he's got his own business, and we can call him retired and we can move him out of transition to retirement. All we have to do is not pay him wages or director's fees and things like that. You have to be very watchful of this, because a declaration is being obtained from the person whether he's retired or working part-time or full-time. But once that declaration has been signed off, you don't have to worry much about it. And once the client turns 60, he can join back full-time and he can still be on an account-based pension anyway. So you just have to look at your clients and see their situation and see whether a transition to retirement pension can become an account-based pension or not. Now, if you move into accumulation account and you're not working, it doesn't mean that you can't withdraw from your super. So let's assume that you have 5 million in the fund. Only 1.6 million is sheltered by the balance transfer cap. The remainder amount of 3.4 million is paying tax. So the question is, can you withdraw any money from the 3.4 million? The answer to that is yes, but it will not be called a pension. It will be called a lump sum. Now, if you withdraw a lump sum from the pension account, it will debit your balance transfer cap. And this is something what I've seen people getting confused by. You can withdraw a pension from a pension account, but you cannot withdraw a pension from an accumulation account. Similarly, you cannot withdraw a lump sum from a pension account, but you can withdraw a lump sum from an accumulation account. So as long as you remember that lump sums can only be withdrawn from an accumulation account, you'll be all right. But in some cases, it is possible to withdraw a lump sum from a pension account. And that case is that your pension is continuing. You commute that pension. That means stop that pension. And then you move the pension amount into the accumulation account. Once it goes into the accumulation account, you withdraw a lump sum. After you've withdrawn the lump sum, then you commence a new pension. So let's say as soon as you commute the pension, your balance transfer cap will be debited by the full amount. But once you start the pension again it will credit your balance transfer cap. And that will be a new pension after a certain date. All you have to remember is that a lump sum cannot be counted for minimum pension payments from now on. So this is, you really need to understand the two, and this is a little complicated, and I've decided to dedicate a separate webinar for lump sums and minimum pensions and reversionary pensions, and I welcome you to subscribe to that webinar. Now, you must understand the debits and credits. Basically, a person's superannuation, when when you debit it, it's when the interest is actually debited, or if the income stream is commuted. If we kill the pension, then we'll debit it. Unless there's a settlement, which is a structured settlement contribution, we're not going to talk about that. Now, there is another case where there are losses or frauds, then there is a provision that your balance transfer cap will be debited. Now, if you have the unfortunate event of a divorce, then if some amounts via court order are being credited to your member account, and if you are on pension, then if you're drawing an income stream and the court order actually um, requires you to remove a certain amount from your income stream to your spouse's, your ex-spouse's superannuation balance, then that can cause a debit to your transfer balance cap amount. Now, internal rollovers, because now you will have pension accounts more than 1.6 million. I'm sorry that I'm going over time, but uh, the issue is quite complicated, and I'll be finished only in the next slide. So please allow another couple of minutes. Now, you have a pension account. This is a situation where you have a pension account and now you want to commence an account-based pension. How will this happen? The first thing you have to do is whether the trust deed allows it or not. Internal rollovers are allowed by our current trust deed. So if you are buying, if you have bought, or if you are using a trust deed from trustdeed.com.au, a self-managed super fund trust deed, our trust deed allows an internal rollover. So all is what is required is a minute and a letter of commutation request from the member. And because now you're commencing a new pension with new pension figures, you'll have to commence a new pension on the 1st of July. And the way we recommend it is that the date of the letter of commutation, that is finishing off the old pension, is 30th of June, and the commencement of the new pension is on actually 1st of July, although there is a 1 minute difference between the two. And when you commence a new pension, you should consider things like reversionary or non-reversionary pensions. And this could be your opportunity to actually adjust your tax-free and taxable component. And what I mean by that is basically if you are going to do that, and if you have a very high taxable amount, and this is the example which I'm using, that if the member balance is 1.2 million, and if you want to commute that pension and you want to move it into accumulation, or you just want to commence another pension with that amount, before 30th of June, if you're below 65, before 30th of June 2017, you can actually withdraw 540 and you can commence a pension with 660 with taxable component. And once this pension is commenced, then you contribute that 540, and that 540 would be non-concessional component, and then you can commence pension number two. So these are some of the things, some of the strategies which you should be putting into place with your clients, talking to your clients and seeing whether these options are possible or not. And if you'll notice that I've put a figure of a member balance of 1.2 million. So this is intentional because if the member is above the preservation age, and the balance is not more than 1.6 million, this is your opportunity to convert your taxable component into tax-free component. Now, uh, I have one bad news. Once, let's say the balance is more than 1.6 million, and you're moving some amounts from pension accounts into accumulation accounts, and then the fund earns income. Now, when the fund earns income into the pension account, then whatever is the taxable tax-free component of that pension account, the income is credited to that pension account in the same percentage, the proportionate basis rules. But when the fund has an accumulation account and it earns income, so in future, if your members have more than 1.6 million, now all of a sudden they will have accumulation account, which they never had before. But any income being credited to the accumulation account, and you will have to accumulate, you will have to allocate income to the accumulation account. The reason you will have to allocate is because that is what the actuary will determine. And any income credited to the accumulation account will be taxable component. And why it is bad news? Because we know that when taxable component is paid on death to a dependent, it is tax-free. But any taxable component which is paid to a non-dependent, and who's a non-dependent? A child over 18, a student over 25, who's not disabled. So any kids getting a taxable component will be paying tax at the rate of 15% plus Medicare levy, which could be 17%. Now this is fine because if the first spouse dies, all the member lump sums go to the second spouse, even if we have reversionary pensions. But when the second spouse dies, if we have a lot of accumulation accounts sitting in the fund, then it is possible that on the death of the second member, if the money is going to adult kids, then taxable components will pay tax at individual level. And I welcome you to, register yourself for the reversionary pensions webinar, where I take a few examples and show you how this happens. There's another opportunity or a strategy which is available, and this is which was actually done very recently. There was a fund which with 5 million with husband wife, they withdrew 1.8 million because 1.8 million was above the 3.2 which they were allowed, and they had two kids and both were married, so they set up two new funds. So what they did was they contributed 450,000 for each couple. So they gave 900,000 to one child and they gave 900,000 to the second child. So now, and this couple was quite an elderly couple. So they were in their 80s. So they decided that this was the time, and the fund balance was 5 million. This was the time to actually hand over. So open second fund and open the third fund for the two kids, and they were also members of the fund. So the two sons were members, their spouses were members, and these two members who are also members. Now, before you go out and set up self-managed super funds, you should be aware of the legislation where you are supposed to give advice and you have to be licensed. And we have again a webinar on that in a couple of weeks there, and I welcome you to register for that webinar and what the options are. And we have a very nice option for you. That option is basically SMSF deed. You can basically integrate with your website, and I'm going to talk about that on that seminar day. So what we are doing at TrustDeed at the moment is, this is my last slide, is we have updated our TrustDeed, but there's certain legislation which has not passed through the Senate, and there are budget announcements regarding $30,000 which can be withdrawn by members who have never purchased their own home before the preservation age. So we're just waiting for that to be legislated, and those people who want to contribute another 300,000 over and above the non-concessional cap by selling their own home if they've stayed in their own home for more than 10 years. So we're just waiting for those pieces of legislation to walk through Parliament, and then once that is done, we will update our deed. We are quite conscious that our deed should be updated before 1st of July. If these announcements are not legislated, we will update our deed on 1st of July. I also welcome you to use smsfdeed.com.au, because on that form you can do three things and it's much cheaper than trustdeed.com. And there'll be one form. You can create a corporate trustee, you can create a SMSF deed, and you can apply for ABN, which is for free. And this form is being, at the moment, being moved into TrustDeed as well. So on TrustDeed as well, you will be able to create a company and the TrustDeed and apply for the ABN in the same application. I thank you for being with me for more than an hour, and I'll now, if you wanted to leave the webinar, I will I will now try to answer some of these questions, and those who have finished, who don't want to wait, they can leave the seminar, who can leave the webinar. Uh, the first question I've got is, our PowerPoint printouts, are they available? Yes, Alan. What we'll be doing is I'll be sending my notes and this PowerPoint presentation to Financial Planning Association, and once I get the CPD approval, I would be uploading it on TrustDeed and on online SMSF audit. You will also be able to download the PowerPoint presentation and my notes. Now, the second question I have is from Mr. Patel. He says, any requirement to do 30th June minute or cost-based adjustments? Cost base is your cost base. The market value will become your new cost base. As far as my knowledge is that you don't need to employ a valuer. A trustee can decide the market value. However, if the trustees decide to use a valuer to find out the market value, they can do that. Like I said, it's a double-edged sword, whether to value it high or whether to value it low. And this is only relevant where the asset of the fund is a property, because it's very difficult to actually find out the real value of the property. And there could be a 5% low or a 5% high. So there could be a 10% difference. So I'll let you work this out with your trustees and see what is really good for you. Right, now, Mr. Van, I've got a question from him. He says, Tris, since the member has not retired but age over 65, can she transfer the Tris into an account-based pension? Now, when you are 65, you have met another condition of release. I think condition of release is 111 in Schedule 1 of the Swiss Act. So once you're 65, the TRIS conditions are no more relevant. They are not, the 10% doesn't apply. The commutation rule does not apply because of the age 65. you have met another condition of release, which is nil. So TRIS will automatically move to account-based pension. And what I suggest is that the member should actually write to the trustees, and it's pretty silly because it could be a single member fund uh, with an individual, with two individual trustees or one corporate trustee with one director. So the member must write to the trustee to say that now I'm 65, so can you please automatically change my transition to retirement pension into an account-based pension. Now, will you be able to email out the slides? I'm afraid, Sally, I will not be able to do that. The reason for that is because we are going to upload these slides after the approval, and once that is done, that will happen within a week. The next question is by Suzanne. It says, my first question has already been answered. Thanks. So that's good. The unsegregated method. Next question is, I think that's the question she had. If transitional CGT relief is used, what valuation methods are acceptable? I guess it's the answer was the market value on 30th of June. So if it's unsegregated, then it is 30th of June valuation. If it is segregated, then anywhere between 9th of November. Now another question I have from Suzanne says, do specific assets need to be allocated to pension account that is segregated or use proportional method with an actuarial certificate? So from 1st July, only proportional method, and if your fund is already using on 9th of November segregated method, then what I have described, that is the method which you will use. If you buy an asset after 9th of November, then you cannot use the segregated method. It must remain outside the segregation. After 9th of November, it remains in the unsegregated pool of assets. Right. The other issues were with, I think, right at the beginning of the presentation, to do with the obtaining slides and the volume and how to report credits to ATO. I believe there would be tax credits. I'm assuming Patrick has a question how to report credits to ATO. I'm assuming the tax office will be changing the annual return where the member balance are depicted. Maybe they add a line what has been withdrawn out of super or things like that. So I don't know the answer to your question, but I'm guessing that all will be disclosed in the annual return. The other questions are more to do with sound. Just please note that if you can't hear me on the internet, it's something to do with the wavelength, with the internet speed. And the best thing to do is dial the number on your panel and enter the webinar number, and you can hear me pretty clearly. I have another question from Stephen who says, members aged 60 to 65 currently in TRIS with balances in excess of 1.6 million, can they continue a TRIS? Of course you can continue a TRIS. TRIS is for those people who are working. They are above the preservation age. Whatever they withdraw will be tax free, and this is a good method of actually reducing your taxable income. So basically you withdraw from your super and you live on that money, and you contribute maximum into super and pay only 15% tax. Unfortunately, the contribution amount from 1st of July has gone down for 60 years old from 35,000 to 25,000. So there will be some benefit, but not a lot, but there would be some benefit. But you can remain on TRIS after 1st of July, and any income supporting the TRIS will pay 15% tax. So it'll be kind of like an accumulation, but it's on pension, and that pension is not on retirement phase. So that transition of retirement is not in retirement phase. I have another question again from Stephen. He says, members aged over 65 and working full time, can they take an income stream and continue to contribute to super? Of course, you can contribute into super as long as you want, and some of the by the way, we are running a contribution next week, same time, same day, Thursday next week, we're running a webinar on contributions. There are certain limits. Once you're 75, only mandated contributions, which is the 9.5% can be contributed. But if you're over 65 and below 75, 74 and you're working full time, you can contribute into your self-managed, non-concessional contributions. But the only problem is that non-concessionals you cannot contribute if your superannuation balance is more than 1.6 million. I think what you should do is that you should register for that webinar, and it will talk about contributions only. But in a nutshell, if you have more than 1.6 million, from 1st of July, you cannot contribute. You can contribute now. If you're over 65, you cannot use the bring forward rule, but you'll be able to contribute only 100,000 from 1st of July. This year, you're able to contribute 180,000 if you're more than 65, working or not. Sorry, if you are working. If you're not working, then you cannot contribute. I guess that's it. If there are no more questions, I would like to end this webinar now, and I thank you all, and I look forward to talking to you next week, same time on Thursday. Uh, you must have got an email to register. Next week we are talking about contributions. Thank you very much.